In the late 1990s, the world stood at the edge of what felt like a technological revolution, unlike anything humanity had ever seen. The internet was no longer a curiosity limited to universities and government labs. It was entering homes, offices, and daily life. Email replaced letters, websites replaced brochures, and suddenly every business wanted to be online. Investors believed they were witnessing the birth of a new economic era, one where traditional rules no longer applied. Profits, fundamentals, and cash flow were dismissed as outdated concepts, while growth, clicks, and eyeballs became the new currency of success. Stock markets surged as companies with little more than a website and a bold idea reached billion-dollar valuations. Startups added "com" to their names and watched their stock prices explode overnight. Venture capital flooded Silicon Valley and beyond, chasing the promise that the internet would reshape commerce, media, finance, and human interaction itself. Ordinary people, many of whom had never invested before, opened brokerage accounts and poured their savings into tech stocks, convinced that missing out was a greater risk than losing everything. The excitement was intoxicating. Financial news channels celebrated young founders as visionaries. Day trading became a cultural phenomenon. Office workers checked stock prices at their desks, while taxi drivers and barbers offered investment advice. The belief was simple and powerful. This time was different. Technology had rewritten the rules, and anyone who questioned the rising valuations was dismissed as someone who just didn't get it. But beneath the optimism lay a dangerous reality. Many of these companies had no profits, no clear business models, and no realistic path to sustainability. They burned cash at astonishing rates, relying on constant investment to survive. The stock market was no longer pricing businesses based on what they earned, but on what people imagined they might earn someday. This gap between imagination and reality would soon tear the market apart. The dot-com bubble was not just a financial event. It was a psychological one. It revealed how hope, fear of missing out, and blind faith in innovation can overwhelm rational judgment. And while the bubble eventually burst, the lessons it left behind are more relevant today than ever, as the world once again races through a technology boom, driven by bold promises and speculative belief. As the internet spread rapidly across the world, a new type of company began to dominate the business landscape. These were internet startups, young, ambitious firms built around websites, online services, and digital platforms that promised to change how people shopped, communicated, and consumed information. Venture capital firms, flush with cash and driven by competition, raced to fund these startups before their rivals could. Money became astonishingly easy to obtain, and the speed at which companies were launched, funded, and taken public shattered all historical norms. Traditional barriers to entry seemed to disappear. A small team with a clever idea and a domain name could suddenly attract millions of dollars in funding. Initial public offerings happened at record speed, often before companies had proven that customers were willing to pay for their services. Wall Street eagerly embraced these offerings, pushing stock prices higher on the first day of trading and reinforcing the belief that internet businesses were immune to failure. In this environment, discipline vanished. Startups focused on growth at all costs, spending aggressively on marketing, office space, and hiring, while profitability was postponed indefinitely. The availability of easy money distorted decision-making at every level. Entrepreneurs were rewarded for raising capital rather than building sustainable businesses. Investors chased momentum instead of fundamentals, fearing that caution would leave them behind in a once-in-a-lifetime opportunity. Media coverage amplified the hype, celebrating rapid expansion while ignoring warning signs such as mounting losses and unclear revenue models. The cycle fed on itself. Rising stock prices attracted more investment, which fueled further expansion and even higher valuations. This chapter marks the moment when the dot-com boom crossed into dangerous territory. Innovation was real, and the Internet's potential was undeniable. But easy money blurred the line between visionary thinking and reckless speculation. By abandoning financial discipline in favor of speed and hype, the market created a fragile ecosystem where failure was inevitable. The stage was now set for one of the most dramatic collapses in financial history. By the late 1990s, optimism surrounding the Internet had transformed into something far more dangerous: market mania. Stock prices no longer rose because companies were performing well, but because everyone believed someone else would be willing to pay more tomorrow. Valuations reached levels never seen before, and traditional financial metrics were openly mocked. Analysts invented new ways to justify absurd prices, arguing that profits were irrelevant in a digital economy where scale and speed mattered more than earnings. The phrase irrational exuberance, once a warning, became a badge of honor for investors who believed they were part of a historic transformation. The mania spread far beyond professional investors. Day trading exploded as ordinary people quit jobs or spent work hours glued to trading screens, chasing quick gains. Online brokerage platforms made buying and selling stocks effortless, and stories of overnight millionaires filled newspapers and television shows. Every market dip was treated as a buying opportunity, reinforcing the belief that technology stocks could only move in one direction. Skeptics were ridiculed as outdated thinkers who failed to understand the power of the Internet. Corporate behavior changed as well. Companies focused on boosting stock prices rather than building durable businesses. Accounting practices grew aggressive, masking losses and inflating performance. Executives were rewarded with stock options that encourage short-term price spikes instead of long-term stability. The feedback loop was complete. Hype drove prices higher, higher prices attracted more hype, and reality was pushed further into the background. This chapter captures the psychological peak of the dot-com bubble, where belief replaced evidence and confidence drowned out caution. Markets had become detached from economic fundamentals, floating on expectations that could never be fulfilled. Once belief became the primary driver of value, collapse was inevitable. The only remaining question was how sudden and how severe it would be. As the dot-com bubble expanded, a striking contradiction became impossible to ignore. Many of the most valuable companies in the market were losing enormous amounts of money. Startups proudly reported growing user numbers while quietly burning through cash at alarming rates. Instead of profits, investors focused on metrics like website traffic, registered users, and mindshare, believing that monetization would somehow appear later. Business plans were built on assumptions rather than evidence, and valuations soared without any logical connection to revenue or sustainability. Wall Street played a central role in normalizing this distortion. Investment banks rushed companies to market through initial public offerings, earning lucrative fees while passing the risk to the public. Analysts issued glowing reports on businesses that had never made a dollar in profit, often with conflicts of interest tied to investment banking relationships. The market rewarded growth stories regardless of financial reality, reinforcing the belief that traditional rules no longer applied in the digital age. Inside these companies, spending became extravagant. Lavish offices, expensive advertising campaigns, and aggressive hiring were seen as signs of success rather than warning signals. Cash was treated as unlimited, and efficiency was dismissed as a concern for later stages. The assumption was that scale would eventually solve everything. But scale without profitability only magnified losses. This chapter exposes the core illusion of the dot-com era, the belief that value could exist without viable business models. Innovation can change industries, but it cannot eliminate the basic economics of revenue and cost. By ignoring this truth, the market inflated a bubble built not on future potential, but on collective denial. And denial, once exposed, always ends the same way. By early 2000, the dot-com bubble had reached its peak. Technology stocks dominated headlines, market indices hit record highs, and confidence felt unshakable. The Nasdaq Composite heavily weighted toward tech companies, soared to levels that seemed to confirm every optimistic prediction about the Internet's future. For a brief moment, it appeared that the skeptics had been wrong and that a new economic era had truly arrived. But beneath the surface, cracks were widening. As some companies began reporting disappointing earnings and others quietly failed, doubt crept into the market. A few high-profile collapses triggered a shift in sentiment, reminding investors that expectations alone could not sustain valuations forever. What had once been dismissed as pessimism suddenly felt like realism. Confidence, the fragile foundation of the bubble, began to erode. The market's reaction was swift and unforgiving. Stocks that had climbed rapidly now fell just as quickly. Investors who had entered late rushed to sell, fearing that the opportunity they had chased was slipping away. The same forces that had driven prices' upward momentum, speculation, and herd behavior now worked in reverse. Losses fed fear, and fear fed more selling. This chapter marks the psychological turning point of the dot-com bubble. Once belief was shaken, there was nothing left to support inflated prices. The realization spread that many companies would never generate profits, and the question shifted from how high prices could go to how much value would ultimately be destroyed. The collapse had begun. When the dot-com bubble finally burst, it did not deflate slowly. It collapsed with shocking speed and violence. Technology stocks that had been celebrated as unstoppable engines of a new economy began to fall day after day, erasing years of gains in a matter of weeks. The Nasdaq Composite, once the symbol of digital optimism, plunged relentlessly, wiping out trillions of dollars in market value. Companies that had reached billion-dollar valuations on little more than hope saw their stock prices collapse by 70, 80, or even 90%. For many investors, the losses were not just numbers on a screen. They represented life savings, retirement plans, and years of accumulated wealth disappearing almost overnight. As panic spread, the market exposed the fragility of businesses that had relied entirely on investor confidence to survive. Funding dried up instantly. Venture capital firms, once eager to pour money into risky startups, suddenly demanded profitability and discipline requirements that many dot-com companies could not meet. Layoffs swept through the tech sector as companies slashed costs in desperate attempts to survive. Office spaces emptied, ambitious expansion plans were abandoned, and once celebrated startups quietly shut down their websites for the last time. The promise of endless growth was replaced by a brutal reckoning with reality. The psychological impact of the crash was profound. Investors who had believed the market could only rise were forced to confront how quickly optimism could turn into fear. Media narratives shifted dramatically, moving from celebration to condemnation almost overnight. The same analysts who once praised innovation now questioned how such obvious warning signs had been ignored. Trust in financial markets was shaken, and confidence in technology stocks collapsed, dragging the broader economy into uncertainty. This chapter captures the moment when illusion met reality. The dot-com crash demonstrated that markets driven by speculation can rise faster than logic allows, but they fall even faster when belief disappears. Billions were wiped out, not because technology failed, but because expectations had become disconnected from economic truth. The crash was painful, but it was also necessary, forcing the market to relearn lessons that had been forgotten in the rush toward easy wealth. In the wreckage left behind by the dot-com crash, the difference between illusion and substance became painfully clear. Hundreds of internet companies disappeared almost as quickly as they had emerged. Their websites went dark, their offices emptied, and their ambitious promises faded into cautionary tales. These failures shared common traits: weak business models, dependence on constant funding, and a belief that growth alone could replace profitability. Once the flow of easy money stopped, they had nothing to stand on. The market, which had once rewarded vision without discipline, now demanded results that these companies could not deliver. Yet not every company perished. A small number survived the crash, not because they were immune to losses, but because they possessed something the others lacked: real value. Companies like Amazon and eBay saw their stock prices collapse alongside everyone else. But beneath the falling valuations lay functioning businesses with customers, revenue, and long-term strategy. These survivors cut costs, refocused on fundamentals, and endured years of skepticism before earning back investor trust. Their survival proved a crucial lesson. Technology alone does not create lasting value. Disciplined execution does. The aftermath of the crash reshaped Silicon Valley and global markets. Venture capital became more cautious, emphasizing business fundamentals over hype. Investors demanded clearer paths to profitability, and startups learned that credibility mattered as much as innovation. The culture of excess that defined the late 1990s gave way to a period of reflection and restraint. Many individuals who had lost savings or careers carried the psychological scars for years, shaping a generation's attitude toward risk. This chapter highlights an essential truth about market bubbles. Collapse does not destroy innovation, it filters it. While speculation fades, genuine progress remains. The dot-com crash wiped out illusions, but preserved the foundations of the digital economy that would later reshape the world. The survivors emerged stronger, wiser, and far more disciplined, setting the stage for the next phase of technological growth. Although the dot-com bubble ended in financial ruin for many, its long-term impact on technology was far more complex than simple failure. The crash stripped away hype and excess, but it did not destroy the internet itself. In fact, it forced the technology sector to mature. Infrastructure built during the boom: fiber optic cables, data centers, and early software platforms remained in place long after speculative capital vanished. These foundations, initially created to support unrealistic expectations, later became the backbone of a far more sustainable digital economy. In this sense, the bubble functioned as an expensive but transformative learning phase. After the crash, the tech industry shifted its focus from rapid expansion to efficiency and value creation. Companies that survived learned to prioritize revenue, customer retention, and long-term strategy over flashy marketing and inflated growth metrics. Engineers and entrepreneurs became more disciplined, building products that solved real problems rather than chasing investor attention. The internet evolved from a speculative playground into an essential utility, quietly integrating itself into everyday life through e-commerce, communication, cloud computing, and digital services. The bubble also reshaped how investors approached technology. Capital did not disappear. It became selective. Venture capitalists demanded stronger business models, clearer monetization strategies, and realistic growth projections. This change laid the groundwork for the next generation of successful tech companies, many of which emerged in the years following the crash. The excesses of the late 1990s became cautionary examples taught in boardrooms and business schools, reinforcing the idea that innovation must be paired with discipline. Most importantly, the dot-com bubble changed society's relationship with technology. The crash ended the illusion that the internet alone guaranteed success, but it confirmed something even more powerful. Digital transformation was inevitable. The internet did not fail, expectations did. By separating technological potential from speculative fantasy, the collapse allowed genuine innovation to flourish in a more stable and enduring form. The lessons learned during this painful transition would echo through every future technology boom. The dot-com bubble may belong to history, but its patterns feel strikingly familiar in today's technology landscape. Once again, innovation is moving at breathtaking speed. New technologies, artificial intelligence, blockchain, virtual reality, and platform-based economies promise to reshape the world just as profoundly as the internet once did. Startups reach billion-dollar valuations in record time, often long before they achieve profitability. Investors speak in the language of disruption, scale, and future dominance. Echoing the optimism of the late 1990s, the belief that this time is different has returned, wrapped in new terminology, but driven by the same human instincts. Just as during the dot-com era, easy money has played a central role. Low interest rates and abundant capital have encouraged risk-taking and inflated valuations. Companies are rewarded for rapid user growth and market share, even when revenues lag far behind expenses. Public markets and private funding rounds alike often emphasize potential over performance, trusting that technology will eventually justify today's prices. This mindset mirrors the logic of the dot-com boom, where imagination frequently overshadowed execution. Yet there are important differences as well. Today's tech giants generate enormous revenues and profits, and digital infrastructure is deeply embedded in global life. The internet is no longer an experiment, it is essential. However, this reality does not eliminate risk, it simply shifts it. Speculation now concentrates in new frontiers, where certainty is low and expectations are high. The lesson of the dot-com bubble is not that technology booms are foolish, but that unchecked optimism can distort judgment even in revolutionary times. This chapter serves as a mirror, reflecting past behavior onto the present. History does not repeat itself exactly, but it often rhymes. The same forces of hope, fear of missing out, and belief in endless growth continue to shape markets. By recognizing these patterns, investors and innovators can separate genuine opportunity from dangerous excess, avoiding the mistakes that once turned a technological dream into a financial nightmare. The dot-com bubble stands as one of the most powerful reminders that while technology can transform the world, human behavior remains remarkably constant. At its core, the collapse was not caused by the internet itself, but by the way people responded to its promise. Fear of missing out, blind optimism, and the belief that traditional rules no longer applied combined to create valuations untethered from reality. When expectations outpaced execution, the market was forced to correct itself with devastating speed. This lesson remains as relevant today as it was at the turn of the millennium. For investors, the dot-com era reinforces a timeless truth. Innovation does not eliminate risk. New technologies can change industries, but they cannot change the basic economics of business. Revenue, costs, and sustainability still matter. Long-term success depends on patience, discipline, and the ability to distinguish between vision and speculation. Markets reward belief in the short term, but they reward results in the long term. Those who survived the dot-com crash were not the ones who predicted the future most boldly, but the ones who built businesses capable of surviving reality. For innovators and entrepreneurs, the bubble offers a different, but equally important lesson. Speed and ambition are powerful, but without structure and focus, they become liabilities. The companies that endured were those that adapted, controlled spending, listened to customers, and refined their models instead of chasing hype. Innovation thrives not in chaos, but in environments where experimentation is balanced by accountability. The dot-com crash did not kill creativity, it disciplined it. Looking forward, the greatest lesson of the dot-com bubble is humility. Every generation believes it is witnessing something unprecedented, and in many ways, it is. Yet history shows that even revolutionary change follows patterns shaped by human psychology. Markets rise on optimism and fall on reality. By studying the past, today's investors, founders, and policymakers can avoid repeating the same mistakes. The future of technology remains bright, but only for those who remember that progress is built not on speculation, but on substance.